Hey there, it's Michael Kwan from Financially Alert. In today's video, we're going to be talking about inflation and the effects that it has on the economy and the types of tools that the Fed are using in order to bring this down and what this means for us long term. Okay, so it's no secret that inflation is super high. And just in June of 2022, we got the inflation numbers back and was a whopping 9.1%. So we're definitely all feeling this today. And whether it's we're going out and buying groceries, filling up at the gas station, or just going out to eat, we are feeling these price increases every day. Just think back to how much it cost to buy something just a year ago. And you'll know quickly that, hey, if this keeps continuing at this pace, it's going to be really hard and tough on our wallets. So the federal government is out there and they're doing their part in order to bring these prices down, this inflation that's eroding our dollar. And the way that they do this is just last week, they announced another rate hike of 0.75%. Now, what does this mean? Well, the significance of this is that they just raised it again, and they had just previously done that the last time that they had met. And the reason why that's important is because the Fed is trying to get a control on how much things cost. Now, let's talk about how this works a little bit. And we're actually seeing this actively take effect in the real estate market. Over the past year, we've seen interest rate hikes affect the cost of a mortgage. Now, typically when you go out to get a mortgage, let's just talk about a year ago, you could go out with great credit and secure a 30-year fixed loan for about 2 to 3%. If you go out and get that same exact loan today, it's now going to cost you roughly 5 to 6%. So the net effect is it takes the monthly principal and interest payment and it balloons it much higher. So all of a sudden, that means that people that were able to afford one home just last year are no longer able to afford it because their monthly payments are significantly higher. So what happens with that house is that there's a smaller number of people that are willing to buy that home. And with the decreased demand of people that are out there, it naturally pushes the price down, which is exactly what the government wants to do. And so we're going to start seeing this across the board, whether it's cars, whether it's discretionary goods, and we're going to see them continually to put upwards pressure on these rates so that it's more expensive to finance something. All the Fed is doing is they're increasing the rate, and this trickles down to the banks, the credit card companies. So one of the things that I wanted to share with you guys today is, what does this mean for us as a consumer? Now, of course, if you're going out to get a house, it's going to cost a lot more. If you're going to go buy a car, it's going to cost a lot more. But you may want to hold off on some big purchases just for now, and I'll tell you why. The last thing that you want to do is to buy with high interest rates and high inflation. Currently, we're in an environment that has both. Now, the higher the interest rates go, the more downward pressure we're going to have on prices. And so for me personally, we're looking for a car for my wife, but one of the things that we're doing is waiting and seeing, because as there's more downward pressure with the prices, the better options are going to be available because there's going to be more supply. So consider that. Now, if you do have any credit card debt, it's also important to do what you can to really get that debt down and minimize it, because the last thing you want to do is be affected by the high APRs that are going to be trickling into the system. Finally, it's time to really put on that budget belt. And I don't mean this in a negative way. And a lot of times people don't want to hear about budgets, but for me, a budget, it's not about constraint. It's about being mindful with our money and being focused. And all that means is to look at places and areas that we're spending in life and be mindful. That means, okay, what are the things that are really priorities and what are not? What are the haves and the have-nots? And if there's a big purchase that you want, maybe you can delay it. As I said, the last thing you want to do is buy in an environment that has high inflation and high finance fees. So consider delaying that. And if you really want something, another way that you can go about doing this is to create more income. Consider creating additional income streams by going out and creating a side hustle, or maybe if your work allows it, you can take on some additional shifts. Or if you have a salary job, maybe there's a project that you can be a part of that can pay you an additional bonus. So there's always things that you can do to get the things that you want. However, you want to be mindful. And during this time, if you're not already, consider investing. And for a lot of us, I think dollar cost averaging is a great strategy to go in and invest in the market slowly over time. And this is not financial advice because everyone's situation is a little bit different, but something that you should consider. And I definitely encourage you to go out there and understand what it means to dollar cost average into an index fund. All right. The last thing that you can do in this environment is to ask for a raise. One of the very interesting things that we find ourselves in is we are technically in a recession because last week the NBER just announced that we had a second quarter of negative GDP growth. So that's the second one in consecutive order. And so a lot of people will say, okay, we're in a recession now. And technically, this may be true by certain people's standards. But what's interesting is that the job market is actually still very strong. And at 3.6%, the unemployment rate is at historic lows. So keep that in mind. A lot of companies and your employer may already have factored in this high inflationary environment and passed on the additional costs to their customers, because they also know that the cost of rising human capital is going to affect their bottom line. So to be honest, most companies are not just going to give you an extra raise or cost of living adjustment that meets or exceeds where inflation's at today. So you really have to do your part and go ask. And when you do go ask, I say do your part. Make sure that you highlight your value and offer them anything additional that you're able to. All right, if you liked what you heard, go ahead and subscribe and like this video. That really helped me out a lot. And if you have any questions or comments, feel free to put them below. And remember, today is a great day to become financially alert. See you on the next one.